Chapter 30 Commercial Leases. Introduction Objectives. In this chapter, we will discuss commercial leases and their clauses. At the end of this chapter, you will be able to 1. Identify essential dynamics and characteristics of commercial leasing practice, including its purposes, advantages, rights issues, how space is measured, and common area considerations. 2. Describe various ways leases are structured and how lease costs are established and managed over a lease term. 3. Describe the central thrusts of principal lease clauses in commonly used commercial leases. Key terms. There are some important terms in this chapter. Remember to pay particular attention to these terms when you see them. Common areas. Lease escalation clause. Usable square footage. Rentable square footage. The New York Bureau of Educational Standards requires that you spend 150 minutes studying the material in this chapter. Your course timer can be found in the upper right-hand corner of your screen. Generating income. All the property types we have talked about in a previous chapter can generate income by renting their space. For example, most businesses need office space to run their operations. Most often, these businesses decide to lease the space instead of owning the building. Reasons to lease. There are some important reasons why a business would choose to lease space rather than purchase the building. Most tenants find leasing to be more cost-effective than owning. This is especially true when a business owner requires less space than the amount of space he or she would have to purchase in order to satisfy the business needs in a preferred location. For example, suppose that a tenant requires 10,000 square feet of space to operate his business and the space must be in a specific location. However, the only buildings available in that location have a minimum of 50,000 square feet. In a case like this, a user would prefer to lease 10,000 feet of space rather than purchase 50,000 feet of space and have to worry about leasing the extra 40,000 square feet that the business does not need. In an example such as this, purchasing is not usually a good idea because owning would require a large capital outlay to purchase the 50,000 square feet when that money could be used for other business purposes. In addition, the purchaser would have to lease, collect rents, maintain, and insure the additional space that it does not use. Other reasons to lease. Other reasons that the business in our example might choose to lease even if it could occupy the entire 50,000 square feet are: owning a building would reduce the flexibility of the business. For instance, if the business wanted to move, it might have to sell the property, which could take a long time and tie up their staff and their capital. When the property is leased, the business could move when the lease expires or even renegotiate a release from the lease. When a business owns the property, it must operate, maintain, and repair the building. Engaging in these activities could cause the business to lose focus on its major business activities. If the business decided it wanted to downsize from using the 50,000 square feet, the building owner would have to find someone to use or purchase the excess space. In such a case, the owner might have to renovate the space to meet the requirements of the new tenants. Again, this activity distracts the business from its primary focus. A particular building's potential for generating income depends on two factors: its ability to attract tenants to rent space, the expenses involved with the building's operation. Square footage. Although it may not seem so, square footage is a flexible number. Several terms are used to describe commercial square footage. Gross square footage. This is all of the floor area within the exterior walls of a building enclosed by the roof. Usable square footage. Usable square footage is the footage within the tenant's space and excludes such things as elevator shafts, public restrooms, heating and air conditioning equipment areas, and public stairwells. Carpetable square footage. This is usable square footage, that is every area that can be used as workspace, minus things like closets, pantries, toilets and the like. Rentable square footage. Rentable square footage is typically the usable square footage, plus a portion of the common areas. The difference between usable and rentable square feet is usually 10–15%, with rentable square feet reflecting a higher cost than usable square feet. There is no real legal definition of the rentable term, and landlords are not required to measure space according to a specific set of guidelines. Landlords can inflate the measurements of an area and then drop the price per square foot. This allows the tenant to think that he or she is getting a good deal, while the landlord essentially gets the same return for the space. Loss and add-on factors. The difference between the rentable and usable square footage in a building is commonly known as the loss or load factor. For example, if by measurement it is determined that 12% of a building is devoted to common areas, then this will become the loss factor for every lease in the building. The measurement and calculation of these figures is not an exact science. A number of standards have been established to look at these figures objectively. The major standards used in the New York metropolitan area and Long Island are BOMA, REBNY and AIA. Each has a somewhat different method regarding how to measure common areas and perimeter walls. Prospective tenants should be aware that landlords are often deliberately vague on the measurement of loss factor. From a space utilization point of view, it is vital that a tenant knows that the usable square footage will be sufficient for his or her needs. Prospective tenants will most often be quoted rentable square footage by a broker or landlord. The approximate usable square footage may be calculated by multiplying the rentable square footage by the loss factor, and subtracting the result from the rentable square footage. For example, if the landlord quotes the size of a suite at 5,000 square feet rentable, with a 12% loss factor, you would first multiply 5,000 times 12% to compute the lost area of 600 square feet. Subtracting 600 from 5,000 would yield an approximate usable size of 4,400 square feet. Common areas. The common areas of commercial building include lobbies, elevators, escalators, hallways, public restrooms and utility areas. The costs involved in maintaining mutually used common areas are often charged to the tenants and referred to as common area maintenance or CAM charges. In large regional centers and malls, utilities for heating, cooling and lighting may be apportioned to each tenant, along with charges for cleaning the area, as CAM charges. In today's marketplace, common area maintenance charges are looked at critically by prospective tenants. Because tenants are scrutinizing these charges so closely, buildings owners have been forced into becoming more competitive. In some cases, owners are agreeing to pay some of these charges themselves instead of passing them on to the tenants. In cases where the tenants pay these charges, they are asking the owners to document the charges, showing exactly how the usage is tracked. CAM charges have become a prime negotiating point in many commercial leases. Leases. Income properties are usually leased to tenants for a designated time period. The lease assigns rights, duties and responsibilities between the owner and the tenant. Since the lessor is usually the owner of the property, we have a tendency to use the terms lessor and owner interchangeably. It's also the case that the terms lessee and tenant are used interchangeably. When a property owner is negotiating for the use of his space, he or she should carefully evaluate the financial ability of the tenants. This is a very important component of the process, because the lease is a contract that creates an asset for the owner and a liability for the tenant. Leases can require considerable rent payments over extended periods of time. Therefore, the ability of the tenant to make payments over a prolonged period is very important. In addition, in order to adequately assess the risk involved, the owner must understand the tenant's business, its competitive position in the industry, and the health of the industry itself. Typically, when evaluating a tenant and a lease proposal, the owner considers the following information: financial statements, credit ratings, analyst reports on the firm or the industry, bank relationships, existing obligations, debts and other leases the tenant may have. Underwriting the lease is a very critical aspect of risk assessment, because it ultimately affects the cash flow produced by a property and therefore its value. Additionally, if the tenant defaults on a lease because the business fails and then petitions the court for bankruptcy, the tenant may be allowed to continue to occupy the space and conduct business, while paying little or no rent during the reorganization process. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. Give 2 reasons why a business would want to lease instead of purchase a building. 2. What is rentable square footage? 3. What is the loss factor? 4. What does a lease do? Check your understanding. Answers 1. Give 2 reasons why a business would want to lease instead of purchase a building. Most tenants find leasing to be more cost-effective than owning. Leasing a building allows more flexibility than owning. 2. What is rentable square footage? Usable square footage, plus a portion of the common areas. 3. What is the loss factor? The difference between the rentable and usable square footage in a building. 4. What does a lease do? The lease assigns rights, duties and responsibilities between the owner and the tenant. Calculating rent and determining increases. As you know, real estate has a long economic life. The costs associated with moving or releasing a property can be high for both the owner and the tenant. Because of this, both parties usually prefer to enter into lease agreements that last up to 10 years. But in all fairness, an owner cannot be expected to accept the same rent amount over the life of a long lease. So, there are several methods an owner can use when writing the lease to ensure a fair rental increase over time. The initial rent that a tenant pays under a lease contract is usually a precise dollar amount. This is called base rent. However, the base rent may vary depending on what method the owner uses to calculate rent over the extended term of lease. Here are some common rent calculation methods. Flat lease. In some cases, rents may remain the same for the term of the lease. This is common in apartment leases, but is also used for offices. Flat rents may also apply to other leases that have relatively short terms or when there is frequent tenant turnover. Step up. Some leases include a step-up provision that spells out how the rent will increase periodically and gives the specific amounts and specific dates of those increases. Using this method, the tenant has no surprises, since he or she always knows the amount and date of each increase in the rental payments. For example, the base rent will be $30 per square foot and will increase $2 per square foot for the next 5 years on the anniversary date of the lease. This type of lease is common in office, warehouse, and retail leases. Calculating rent and determining increases. Here are 2 other common rent calculation methods. Indexed. Another way to calculate rent increases is to adjust the rent payments using a specified index such as the Consumer Price Index. When using this method, the rent adjusts periodically according to the change in the Consumer Price Index. This method differs from the step-up method we mentioned on the previous screen, because the tenant will not know the actual change in the rent amount in advance. This method of adjustment is riskier for the tenant than the step-up method. However, since it ties the increase in rent to the level of inflation, it tends to preserve the real value of the lease payments. Since the rent increases with this method are uncertain, it's common for the owner to accept a lower base rent than he or she might in the case of a step-up method. This type of lease is also used in office, warehouse and retail leases. Percentage rent. Yet another method for calculating rent is called percentage rent. This is commonly used in leases for shopping centers and other retail establishments. With this method, the rent is based partially on the tenant's sales volume. The owner charges the tenant a minimum rent that the tenant will pay regardless of the amount of sales. If the sales volume exceeds a certain amount, the owner calculates the rent on a percentage of that amount. The calculated amount is called overage rent. As with the consumer price method described above, it's common for the owner to accept less minimum rent in exchange for collecting increased rent based on the tenant's sales activity. The natural break-even point defines when an investment will generate a positive return. The owner can lower the percentage that the tenant pays in order to help the retail tenant reach the break-even point. As the retailer's business improves, the owner can gradually raise the percentage. Defining expense responsibilities. It's important for the lease to differentiate which party is responsible for which expenses, especially for those expenses such as property taxes, insurance, utilities and maintenance. Gross lease. A gross lease is defined as one in which the owner pays all of the operating expenses and the tenant has no responsibility for these expenses. With a gross lease, the owner bears the risk of all unexpected changes in operating expenses. Net lease. A net lease is defined as one in which the tenants pay the operating expenses. This is also called a full-service lease. Usually with the net lease, the management fees are still paid by the owner rather than the tenants. You may have heard the term net lease or triple net lease to refer to a lease that requires the tenant to pay the fixed expenses of property taxes, insurance and maintenance in addition to the other operating expenses and the rent. With a triple net lease, the tenant bears the entire risk of all the unexpected changes in the operating expenses. Alternatively, the responsibility for expenses can be shared between the owner and tenant. In one case, the owner could pay operating expenses up to a specified amount. Then if the expenses increase above that amount during the term of the lease, either all or part of the increase passes through to the tenant and is added to the base rent. These pass-through expenses could be limited to a few expense categories or to all of them, depending on how the agreement is written. If a tenant leases only part of the building, the pass-through expenses would be prorated, based on how much space that particular tenant actually leases. One benefit of this type of lease arrangement to the owner is that only increases in expenses are passed through to the tenants, but any decrease in expenses is kept by the owner. Loft lease. The word loft has shifted in meaning over the years. It used to mean one big unfinished or semi-finished floor, converted from former industrial space. Then in the 1990s, developers started building lofts. Some of the characteristics you might see in today's lofts include: located near downtown, very high ceilings, exposed pipes and ducts in the ceiling, one large room, floor-to-ceiling windows, exposed interior brick, metal stairs and handrails. Since many lofts consist of one large room with no dividers, a commercial loft lease may include clauses that address the issue of making physical changes to the space. A tenant interested in renting a loft may want to make changes to the space. The loft lease may state that no changes can be made without the owner's written permission. On the other hand, the lease may allow for any non-structural changes the tenant wants to make as long as the changes do not interfere with the utility services. Lease contents. The rights, duties and responsibilities addressed in the lease have an effect on each party for the length of the lease. The terms of the lease include legal considerations that are intended to guard the interests of both the owner and the tenants over the life of their association. The lease also specifies how the tenant will make payments over the life of the lease. The lease agreement usually includes the following items: the date of the agreement, the starting date and the length of the lease, the parties to the lease, the description of the lease space, a description of how the property can be used, a description of any restrictions regarding alterations or improvements to the property, any restrictions that may exist on the operation of the tenant's business, any restrictions regarding assignment or subleases of the property, use of common areas and facilities, requirements for liability insurance, the method for handling delinquent payments, conditions for surrendering the premises, the amount of rent, any method that will be used to calculate additional rent, how expenses will be divided between the owner and the tenant, any allowances for improvements that will be made by the tenant, but paid for by the owner, any lease renewal options, any right of refusal to release the space, any equity participation that the tenant may have in the ownership of the building, Tenant relocation options. All of the above items help to define the characteristics of the lease between the two parties. These items also determine how much risk the owner and tenant are willing to take and outline how much the tenant expects to pay for the use of the space over the term of the lease. Combining all these items establishes the effective cost for the use of the space during the term of lease. Lease options. Offering lease concessions. Some lease contracts can contain concessions that can lower the rental rates. For example, a lease can contain a free rent period. Owners tend to write concessions or discounts into leases during periods of time when there is more than a normal supply of rentable space in the area. When this is the case, an owner may give a tenant 1 year free rent on a 5-year lease. The owner could choose to do this instead of building in an average rent reduction over the entire length of the lease term. Using this method allows the owner to collect higher rents in the later years of the lease. Another type of concession would be for the owner to agree to pay for any improvements the tenant makes to the property. Proposing an equity participation during times when the market is soft, an owner might offer a tenant an equity interest in the building as a means of attracting tenants to the building. This could be an attractive option to a tenant, because it provides a hedge against changes in the cost of leasing the space, since the tenant is a partial owner of the building. Other lease options. Below are some other options that an owner might include in a lease. Lease renewal option. This option allows the tenant to renew the lease for a specified rent amount when the lease expires. This option is only valuable if the renewal rate at the time of the expiration and renewal is below the current market rates at that time. If the pre-arranged rent is above the market rate at the time of renewal, this option is obviously not a good value for the tenant. Right of first refusal. This option gives the tenant the right at the end of the lease term to renew the lease of the same space at the current market rate, before it's offered to other tenants. Sometimes owners will give tenants the right of first refusal on a space adjacent to their own when that adjacent tenant's lease expires. This option allows the tenant to expand its space without having to relocate. These options protect the tenant from having to move and incur the costs of relocation. This option does have some risk for the owner, however. Giving the right of first refusal to the existing tenants could eliminate the opportunity for new blood in the building. Opening the property to a new tenant could improve the prestige of the property if the new tenant has an upscale image and could attract other tenants to the property. For example, in a shopping center, a new, more upscale tenant might attract more shoppers to the shopping center and improve the sales potential, and ultimately the percentage rents that the owner will receive from that shopping center. More lease options. Tenant relocation option. This option allows the owner to relocate the tenant to another space in the same building during the term of the lease. This would be particularly beneficial to the owner if another tenant wanted to expand his or her space into an adjacent space. This option gives the owner the flexibility to move an existing tenant to another place in the building. While this is advantageous to the owner, the moved tenant could sustain relocation costs and potentially be in a less desirable part of the building. As you can see from our discussion, owners and tenants can have variations in their willingness to incur various levels of risk. For this reason, it's not uncommon to see variations in lease provisions for different tenants within the same building. In addition, lease terms often change depending on the current economic conditions. For example, if an area is experiencing a high vacancy rate, owners will tend to offer more concessions to tenants than they would when occupancy is closer to normal for that area. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. What is a step-up lease? 2. Describe the difference between a gross lease and a net lease. 3. List 5 items normally contained in a lease. 4. What does the right of first refusal in a lease give the tenant? Check your understanding. Answers 1. What is a step-up lease? A lease containing a provision that spells out how the rent will increase periodically and gives the specific amounts and specific dates of those increases. 2. Describe the difference between a gross lease and a net lease. A gross lease is defined as one in which the owner pays all of the operating expenses and the tenant has no responsibility for these expenses. A net lease is defined as one in which the tenants pay the operating expenses. 3. List 5 items normally contained in a lease. The date of the agreement. The starting date and the length of the lease. The parties to the lease. The description of the lease space. A description of how the property can be used for. What does the right of first refusal in a lease give the tenant? This option gives the tenant the right at the end of the lease term to renew the lease of the same space at the current market rate, before it's offered to other tenants. Common lease clauses. Earlier in this course, we talked about residential leases. However, persons who need to lease commercial or industrial space generally have different needs than residential tenants. Commercial leases are generally much longer in duration and much more expensive. Unlike residential leases, commercial lease agreements are not standard. Each lease agreement is written to reflect the space being leased and the specific needs of the tenant. However, there are several lease clauses that are generally included in all commercial leases. Use clause. Subordination, non-disturbance and attornment. Estoppel. Sublease assignment. Electric service. Let's discuss each of these further. Lease clauses. Use clause. This lease provision restricts a commercial tenant's use of the rented space by indicating what business activities are allowed by the tenant. The property owner doesn't want his or her property used for unauthorized or illegal uses, nor in ways that are detrimental to other tenants. So the owner will try to keep this clause as narrow as possible. The tenant, on the other hand, wants this clause to be as broad as possible. It's important for the tenant to let the owner know all the possible uses he or she intends for the property, so that the owner can be sure all uses meet insurance and building code purposes. Use violations could pose major problems for both owner and tenant. Subordination, non-disturbance and attornment. The subordination, non-disturbance and attornment agreement is the document that an owner, tenant and lender often use to describe and verify how their rights do and will overlap. This agreement addresses how and when the rights of tenants will be secondary to the rights of lenders or, sometimes at the lender's option, superior to the rights of the lenders. It guarantees tenants that their rights to their premises will be protected on defined conditions within their control. For example, the non-disturbance clause might state that the lender or any future owners may not terminate the tenant's lease as long as he or she fulfills the lease obligations. These protections will remain in place even if the owner defaults on the loan and the lender forecloses. The final component of the SNDA agreement is the attornment. The term attornment refers to the consent to a transfer of a right. It usually describes the situation where a tenant accepts being a tenant of the new landlord by staying on location after the sale of the leased property. Estoppel Certificate. An Estoppel Certificate is a document designed to give a third party critical information on the relationship between an owner and his or her tenants. The third party is frequently a prospective purchaser of the owner's property or a lender who will be secured by an interest in that property. Typically, the deal that the owner is making requires the owner to obtain such certificates from his or her tenants and present them to the third party for use in its due diligence review of the property. Most retail space leases have provisions which require the tenant to prepare and sign estoppel certificates at the owner's request. Typically, the tenant is required to certify that as of the date of the document, certain things are true, or to specify in some detail why they are not true. The things usually covered include whether the tenant's lease is in full force and effect and has not been assigned, modified, supplemented, or amended. All conditions under the lease to be performed by the landlord have been satisfied. Any required contributions by the landlord to the tenant on account of the tenant's improvements have been received by the tenant. There are any existing claims, defenses, or offsets which the tenant has against the enforcement of the lease by the landlord. Any rent or related payment obligation has been paid more than 1 month in advance. Any security has been deposited with the landlord. Sublease assignment. Most leases do not allow sublease or assignment without the owner's consent. Sometimes, commercial tenants do not need all the space they have leased, so they want to sublease part of it. In other cases, they may want to assign the property to another tenant and vacate the premises entirely. Either of these options is favorable for the tenant and may be an important negotiating point. Sublease. A sublease transfers only a portion of the leasehold interest to another person. The original tenant holds the reversionary interest in the leasehold and remains directly liable for payment of the rent to the landlord. The subtenant pays rent to the original tenant who pays the landlord. Assignment. In an assignment, the tenant conveys the leasehold, with all its title, rights and interests in the leased property, to another person. That person, called the assignee, becomes primarily liable for the rent payments to the landlord, while the original tenant remains secondarily liable. Electric service. Direct metering. A significant number of housing units across New York State are master metered. This means that a multiple dwelling has one electric meter for the entire building and the owner pays the utility for all electric consumed in the building. The use of electricity by tenants is not regulated or billed in any manner. Their electric usage is included in the rent. In an effort to encourage the statewide goal of energy conservation, building owners are allowed to terminate rent inclusion of electricity and have the tenants, who receive an appropriate rent reduction for loss of the service, individually metered and pay their own electric costs. Direct metering and submittering. The individual metering of apartments can take the form of either direct metering or submittering. With direct metering, the tenant purchases electricity directly from a utility company which installs the electric meter, reads the tenant's electricity usage and bills the tenant at a residential rate. In the case of submittering, the tenants pay the owner or the owner's contracting service company for the electricity they use. The electrical usage is measured by a submitter installed by the owner's contractor and rent by the service company. Submittering has the advantage of reducing the cost of electricity to the tenant, since the bulk rate paid by the owner, even when combined with the owner's meter reading and billing costs, is normally significantly less than the residential rate. Other lease clauses. There are a number of other clauses that can be found in a commercial lease. Let's take a brief look at some of them. Premises clause. Somewhere near the beginning of the lease is a clause that identifies the space that the tenant will be occupying. This clause is often titled premises. If the tenant is leasing an entire building, the clause should simply give the street address and describe any outbuildings or lots that come with it. If the tenant is only leasing part of the building, the lease will need to describe the space more precisely to include any access to storage rooms, conference rooms, parking, kitchen facilities, and other areas. Term clause. This clause describes the length of the lease and specifies the starting and ending dates. Even though it may seem straightforward, this clause can be tricky. For example, some leases start as of the date the lease is signed, even though the tenant has not conducted business for even a day. Though the tenant might not be responsible for rent right away, he or she will be responsible for other obligations in the lease, such as the requirement to carry insurance. Done properly, leases should have many start dates, corresponding to when the tenant can gain access to set up, when the rent is due, when the tenant becomes responsible for securing insurance, when the tenant can open for business, and so on. Other lease clauses. Security deposits. The owner may ask for a security deposit to assure that cash will be available if the tenant fails to pay the rent or doesn't make other payments required under the lease. Unlike residential landlords, who in many states may not ask for more than 2 months' rent as a deposit, commercial landlords may demand whatever amount they think they need as a cushion to cover rent and other tenant financial obligations. Instead of a security deposit, the owner may ask for a letter of credit from the tenant's bank, in which the bank puts aside an agreed-upon amount of the tenant's funds for use by the landlord if the tenant does not fulfill his or her financial obligations. Improvements and alterations. If the new space will have to be customized to suit the tenant's needs, the lease should address this issue. The tenant and the owner will have to reach an agreement about who does the design, who does the work, when it gets done, and who pays for it. If the tenant is going to occupy space in a building not yet completed, the tenant will want to be certain that he or she pays for as little of the finish-up work as possible. Other lease clauses. Maintenance, utilities, and code compliance. The landlord's lease will most likely contain a maintenance clause that discusses the tenant's responsibilities to take care of his or her own rented space or for the entire building, if the tenant is the sole tenant. If in a multi-tenant building, the tenant and the owner will also have to settle on how the utilities will be billed and paid for, so there will also often be a utilities clause in the lease. Finally, the landlord may expect the tenants to keep the building up to code. This would be addressed in a lease clause sometimes titled Compliance or Compliance with Laws. Parking, signs, landlord's entry, and security. There may also be several clauses in the lease that deal with practical understandings the tenant has with the owner about such things as parking and business signs. As these clauses are negotiated, both parties will be trying to smoothly integrate their needs. Although these clauses may not be as impactful as rent or maintenance clauses, they can be very important to a successful and convenient tenancy. Other lease clauses. Insurance clauses. Several kinds of insurance are available to cover the risks of leasing commercial space, including property and liability insurance, rental interruption insurance, which covers a tenant if business is unexpectedly interrupted, as would happen after a natural disaster. Leasehold insurance, which protects a tenant if the lease is cancelled due to circumstances beyond his or her control and the tenant has to rent elsewhere at a higher rent. Each tenant must evaluate each type of insurance coverage in the context of the lease and the landlord's requirements, the tenant's business needs, and the property, and negotiate accordingly. An insurance broker can help too, especially when it comes to choosing adequate levels of coverage. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. What is an Estoppel Certificate designed to do? 2. What is the difference between a sublease and an assignment? 3. What is the difference between direct metering and submittering of electric usage? 4. Which lease clause would address the issue of a tenant needing to make changes to the lease space? Check your understanding. Answers 1. What is an Estoppel Certificate designed to do? An Estoppel Certificate is a document designed to give a third party critical information on the relationship between an owner and his or her tenants. 2. What is the difference between a sublease and an assignment? In an assignment, the tenant conveys the leasehold, with all its title, rights and interests in the leased property, to another person, who then becomes primarily liable for the rent payments to the landlord. A sublease transfers only a portion of the leasehold interest to another person, leaving the original tenant directly liable for payment of the rent to the landlord. 3. What is the difference between direct metering and submittering of electric usage? With direct metering, the tenant purchases electricity directly from a utility company. In the case of submittering, the tenants pay the owner or the owner's contracting service company for the electricity they use. 4. Which lease clause would address the issue of a tenant needing to make changes to the lease space? Improvements and alterations clause. Lease escalation clauses. Many long-term commercial leases contain a lease escalation clause in which the parties agree to a rent adjustment based on set increases in taxes, insurance, maintenance, and other operating costs. During the past 30 years or so, landlords have developed the custom of separating the base rent for the occupancy of the leased premises from escalation rent. This technique allows the landlord to better ensure that the net rent received under the lease will not be reduced by the normal costs of operating and maintaining the property. In addition, the landlord is able to quote a lower rent to attract tenants while protecting itself against inflation and fluctuation in operating expense and tax levels over the term of the lease. There are several different types of lease escalation clauses. Proportionate shares of occupancy. Base year. Operating tax stop. Real property tax clause. Direct operating. Porter's wage escalation formula. Consumer price index. Fixed percentage increases. Let's look at each of these further. Lease escalation clauses. Proportionate shares of occupancy. The tenant's lease will specify the percentage of the space a tenant occupies. Then, in addition to the rent, the tenant will be responsible for paying its proportionate share of any increases in operating costs. For example, if there is a tax escalation clause, whenever the property taxes go up, the tenant will be expected to pay a proportionate share of that increase. Base year. In many commercial leases, depending on how they are written, the owner will pay all of the operating expenses for the first year, also called the base year. Tenants will not have to pay any increases under the lease escalation clauses until after the base year has passed. But negotiating the base year can be tricky. Usually, landlords will give the tenant a full year of protection from increases. However, if a tenant moves into a space in May or June and does not ask for the full 12-month period, the tenant could start seeing increases in January of the next year. On the other hand, if a tenant moves into a space in September or October, some landlords will grant the next full year as the base year, which gives the tenant 15 to 16 months of protection from increases. Lease escalation clauses. Operating stop. Tax stop clause. An operating stop in a lease stipulates an amount of operating expenses above which the tenant must bear. Often the base amount is the amount of expense for the first full year of operation under the lease. Example: the stop clause requires the tenant to pay all utilities in excess of $2,500 per year. If utilities are less than that amount, the landlord pays them. A tax stop clause in a lease stops a landlord from paying property taxes above a certain amount. Example: the tax stop in the lease required the tenant to pay all property taxes in excess of $1,200. Real property tax clause. Tax escalation clauses are provisions that permit landlords to recover or share increased real property taxes with their tenants. The typical clause provides for tenants to pay a specified percentage of tax increases over a base tax figure. Some leases also include a rent escalation clause which may specify that rent due will increase with inflation or at some other specified times. Lease escalation clauses. Direct operating. This type of lease escalation clause passes on prorated increases in taxes, heat, maintenance and other direct costs. The lease should exclude capital improvements and management fees from this calculation, as well as other types of costs. Porter's wage escalation formula. This is an indexed escalation formula, used primarily in New York City or by New York area landlords. This formula replaces or can be in addition to operating expenses. The Porter's wage escalation is based on the contract entered into every 3 years between the local building services union and a coalition of New York building owners. The formula provides that the rent will increase a specific amount per square foot based on a specified increase in a porter's hourly wage. The reasoning behind this formula is that wage increases for this category of labor closely reflect increases in the building's overall operating costs. The most commonly used porter's wage variations enable building owners to recover significantly more than they would by billing direct operating expenses. Typically, the porter's wage escalation becomes a major profit center for a landlord. Porter's wage clauses can be constructed to avoid this and to provide the owner with an amount roughly equal to a well-negotiated and audited direct operating expense clause. Lease escalation clauses. Consumer price index. The CPI can also be used to determine the rate of rent escalation. Every month the Bureau of Labor Statistics of the U.S. Department of Commerce publishes the CPI, which indicates changes in the cost of living. The CPI acts as a price indexing scale for the landlord to use in measuring the loss or gain of the dollar. By using this index to determine rent, the landlord can feel assured that the net rent is not eroding during the term of the lease. A CPI clause in a lease should contain some of the following elements. Which particular index will be used, since different indexes measure different items. Geographic coverage, such as the U.S. city average or a local area index. Index base and base year. Percentage of the CPI increase that applies to and increases the base rent. Provision for a substitute replacement index if the particular CPI index is discontinued. Fixed percentage increases. A flat fixed annual percentage increase in base rent is a way of escalating rent by increasing it by a fixed percentage each year. The disadvantage of a fixed percentage increase is if the CPI goes higher than the fixed rate will not be keeping up with inflation. Lease terms for different property types. Different property types customarily have different lease terms. Hotel and motel rooms typically rent on a daily basis. Homes and apartments are usually leased on a yearly basis, although leases could be longer or shorter. The terms are usually renegotiated when the lease expires. Space in office buildings tends to be leased for a 3 to 5 year term. Often the tenant has the option to lease for an additional 3 to 5 year term. As we discussed earlier, leases may include provisions for rent increases as step-ups or as an inflation adjustment tied to the consumer price index. Tenants must also share in the payment of expenses such as property taxes, insurance and maintenance. As you might imagine, office rents vary by location within the property itself. An owner could choose to charge higher rents for the following spaces. Ground floor offices, transfer points or offices near elevators. Higher floors with good views. Corners of the building. On the other hand, an owner could choose to discount the rent for the following spaces. Middle floors or space far from elevators. Offices with poor or obstructed views. Non-adjacent space. For example, having part of the business on one floor and the rest on another floor. Lease terms for different property types. Retail space leases vary considerably. If the business is small, the tenant may lease space for only 1 or 2 years. Larger businesses may be willing to commit to much longer lease terms. Most shopping centers have percentage leases with minimum rents. Retail properties are subject to many changing trends. In addition to rent and expenses, retail leases often contain provisions that affect how tenants may or may not operate their businesses. This is because most retailers will be operating their businesses close to other retailers. Furthermore, some tenants may have the right to approve leases being negotiated with competing retailers. Retail leases with some tenants may also prohibit leases to certain other tenants that may be considered incompatible or that may detract from or interfere with the operations of the existing retailers. Lease terms for different property types. Here is information about the lease terms for these property types. Many industrial properties have special purpose buildings. Because of this special use nature, leases are usually individualized. Most leases have a 3 to 5 year term, although many tenants prefer longer-term leases, especially when they are installing expensive equipment that would be very difficult to move. Most industrial leases are net leases. An owner could choose to charge higher rents for the following spaces in an industrial or warehouse complex: space near the entrance to the park, space near interstates or railroads. On the other hand, an owner could choose to discount the rent for space with poor entrance or exit space where traffic flow is poor. Agricultural leases can vary depending on the use of the property. Leases for hunting rights are typically shorter than farming leases. Hunting leases are usually for 1 year, while farming leases typically last 3 or more years. Many of the terms for agricultural leases are the same as those we've already discussed. However, most farming leases need to address the issue of environmental concerns. While in the event of an environmental problem the owner is ultimately responsible, it's important that the tenants agree in the lease to adhere to appropriate and accepted farm practices and legislation relating to the environment, such as manure disposal and pesticide and herbicide applications. Check your understanding. Print this screen. Answer the questions and then advance to the next screen to see the answers. 1. What is a lease escalation clause? 2. What is a base year? 3. What is Porter's wage escalation formula? 4. Why my tenants leasing industrial property prefer to have very long-term leases? Check your understanding. Answers 1. What is a lease escalation clause? A clause in which the parties agree to a rent adjustment based on set increases in taxes, insurance, maintenance and other operating costs. 2. What is a base year? Typically, the base year is the first full year of operation. However, it can be less than 12 months or more than 12 months, depending on what the owner and tenant negotiate at the time the lease is signed. 3. What is Porter's wage escalation formula? An indexed escalation formula based on the contract entered into every 3 years between the local building services union and a coalition of New York building owners. The formula provides that the rent will increase a specific amount per square foot based on a specified increase in a porter's hourly wage. 4. Why my tenants leasing industrial property prefer to have very long-term leases? They might have this preference if they are installing expensive equipment that would be very difficult to move. Summary review. This concludes Chapter 30. Below is a summary which you can review before taking your quiz. There are some important reasons why a business would choose to lease space rather than purchase a building. Most tenants find leasing to be more cost-effective than owning. Owning a building would reduce the flexibility of the business. Engaging in maintenance and repair activities could cause the business to lose focus on its major business activities. If a business decided it wanted to downsize, the building owner would have to find someone to use or purchase the excess space. Usable square footage is the footage within the tenant's space and excludes such things as elevator shafts, public restrooms, heating and air conditioning equipment areas, and public stairwells. Rentable square footage is typically the usable square footage, plus a portion of the common areas. The difference between the rentable and usable square footage in a building is commonly known as the loss or load factor. The common areas of commercial building include lobbies, elevators, escalators, hallways, public restrooms and utility areas. The lease assigns rights, duties and responsibilities between the owner and the tenant. Summary review. Summary. Some common rent calculation methods include: flat lease rents may remain the same for the term of the lease. Step-up lease that spells out how the rent will increase periodically and gives the specific amounts and specific dates of those increases. Indexed a lease that adjusts the rent payments using a specified index such as the Consumer Price Index. When using this method, the rent adjusts periodically according to the change in the Consumer Price Index. Percentage rent. With this method, the rent is based partially on the tenant's sales volume. A gross lease is defined as one in which the owner pays all of the operating expenses and the tenant has no responsibility for these expenses. A net lease is defined as one in which the tenants pay the operating expenses. Some lease contracts can contain concessions that can lower the rental rates. A lease renewal option allows the tenant to renew the lease for a specified rent amount when the lease expires. A right of first refusal option gives the tenant the right at the end of the lease term to renew the lease of the same space at the current market rate, before it's offered to other tenants. A tenant relocation option allows the owner to relocate the tenant to another space in the same building during the term of the lease. Summary review. Summary. Several lease clauses are generally included in all commercial leases. Use clause restricts a commercial tenant's use of the rented space by indicating what business activities are allowed by the tenant. Subordination, non-disturbance and attornment, the document that an owner, tenant and lender often use to describe and verify how their rights do and will overlap. Estoppel, designed to give a third party critical information on the relationship between an owner and his or her tenants. Sublease assignment, not usually allowed without the owner's consent. A sublease transfers only a portion of the leasehold interest to another person. In an assignment, the tenant conveys the leasehold, with all its title, rights, and interests in the leased property, to another person. Electric service. The individual metering of apartments can take the form of either direct metering or submittering. With direct metering, the tenant purchases electricity directly from a utility company which installs the electric meter, reads the tenant's electricity usage, and bills the tenant at a residential rate. In the case of submittering, the tenants pay the owner or the owner's contracting service company for the electricity they use. Summary review. Summary. Other clauses that can be found in a commercial lease include Premises Clause, Term Clause, Security Deposits, Improvements and Alterations, Maintenance, Utilities, and Code Compliance, Parking, Signs, Landlord's Entry, and Security. Insurance Clauses. Many long-term commercial leases contain a lease escalation clause in which the parties agree to a rent adjustment based on set increases in taxes, insurance, maintenance, and other operating costs. There are several different types of lease escalation clauses. Proportionate shares of occupancy. The tenant will be responsible for paying its proportionate share of any increases in operating costs based on the percentage of the space that tenant occupies. Base year. Tenants will not have to pay any increases under the lease escalation clauses until after the base year has passed. Base year is the first year of operation. Operating tax stop stipulates an amount of operating expenses above which the tenant must bear. Real property tax clause provides for tenants to pay a specified percentage of tax increases over a base tax figure. Direct operating passes on prorated increases in taxes, heat, maintenance, and other direct costs. Summary review. Summary. Other lease escalation clauses. Porter's wage escalation formula. An indexed escalation formula provides that the rent will increase a specific amount per square foot based on a specified increase in a porter's hourly wage. Consumer Price Index. Rate of rent escalation based on changes in the cost of living. Fixed percentage increases, a way of escalating rent by increasing it by a fixed percentage each year. Different property types customarily have different lease terms. Hotel and motel rooms typically rent on a daily basis. Homes and apartments are usually leased on a yearly basis. Space in office buildings tends to be leased for a 3 to 5 year term. Retail space leases vary considerably, from only 1 or 2 years to much longer. Many industrial properties have a 3 to 5 year term, although many tenants prefer longer-term leases. Agricultural leases can vary depending on the use of the property. In the next chapter we'll be talking about income tax issues. Get ready for a quiz. Good luck! 1 of 18 leases for small retail businesses tend to be for 1 to 2 years. 2 of 18. What is the footage within the tenant's space that excludes such things as elevator shafts, public restrooms, heating and air conditioning equipment areas, and public stairwells? Usable square footage. 3 of 18. With what type of lease do the tenants have the right to approve leases being negotiated with competitors? Retail. 4 of 18. If the landlord quotes the size of a building at 9,000 square feet rentable, with a 18% loss factor, how much usable space is there? 7,380 square feet. 5 of 18. What kind of lease includes a provision that spells out how the rent will increase periodically and gives the specific amounts and specific dates of those increases? Step up. 6 of 18. What document assigns rights, duties and responsibilities between the owner and the tenant? The lease. 7 of 18. Leases are usually individualized and are net leases. Most leases have a 3 to 5 year term, although many tenants prefer longer-term leases, especially when they are installing expensive equipment that would be very difficult. Industrial. 8 of 18. The owner may ask for and to assure that cash will be available if the tenant fails to pay the rent or doesn't make other payments required under the lease. Security deposit. 9 of 18. If the landlord quotes the size of a building at 128,000 square feet rentable, with a 11% loss factor, how much usable space is there? 113,920 square feet. 10 of 18. The restricts a commercial tenant's utilization of the rented space by indicating what business activities are allowed by the tenant. Use clause. 11 of 18. All of the floor space within the exterior walls of a building enclosed by a roof is what kind of square footage? Gross square footage. 12 of 18. Which type of insurance is typically purchased to cover the risks of leasing commercial property? Rental interruption insurance. 13 of 18. How is usable square footage determined? Rentable square footage minus 14 of 18. If an environmental issue occurs when the agricultural property is leased, who is ultimately responsible for the issue? The landlord. 15 of 18. Which of the following is not a reason to lease instead of buy? Less flexibility with leasing. 16 of 18. The difference between the rentable and usable square footage is the loss factor. 17 of 18. Many long-term commercial leases contain an in which the parties agree to a rent adjustment based on set increases in taxes, insurance, maintenance and other operating costs. Lease escalation clause. 18 of 18. Which lease escalation clause passes on prorated increases in taxes, heat, and maintenance to the tenant? Direct operating.